everybody. This is our Horizon Apartments 204 units in San Antonio. It's accredited investors only now, switched from 506B earlier. So let's get started. So I've got executive summary, of course, the most important thing, the team, property, our business plan, and then the underwriting and the details for investing. Before we get started, this is a risky investment. And so, do your due diligence, look at all the details. Please ask us any questions. Trevor, Maria, of course, TVG team, Jasmine, massive team, Amber, Renee, we have all the co-GPs we have on this deal. Please reach out and ask the questions to understand and be comfortable. None of it is here is a legal, financial, or tax advice. This is an actual deal. We have some projections, so it has risk. So be careful. But we like this deal. So the most important thing for any deal is the sponsorship team. So on this team, we have TVG on the left-hand side. Jose also goes as Nacho. Jose, part of not a TVG team, and Vinny. They are here on the call, so they will be available for questions after we go through the slides. And on the right-hand side, massive capital team, me, Schreier, Mike. Of course, TVG team has presence in San Antonio. They have deals they manage in Texas, South Valley, as well as San Antonio. Massive capital, we have one small deal in San Antonio market, but Houston, Dallas, we have deals in that market. Just from TVG and massive capital combined with Amber, Janae, and Tom, they are part of our team to handle boots on the ground. So Tom is locally in San Antonio. Amber, Janae are about less than an hour in Austin. But between all of us, and this is just a summary of our track record. Not everything, I think we have a little more, but at least gives a snapshot. 20 deals completed, 7 full cycle, over 3,000 units under management across all of us. A little over 500,000 assets under management, with assets in Colorado, Georgia, North Carolina, and of course, Texas. In addition to TVG, Massive, and Amber, Janae, we have Liz and Barbie, Ronald and Mary are on the line. I saw earlier Tariq and Rochelle also helping us out on this deal. So just a summary of this deal, why we like this deal. We love this deal. It's a very strong submarket. San Antonio is a great market and a submarket. So on the map on the right-hand side, you can see Amazon warehouses and where this is located. I've got bigger maps later in the presentation that I'll share that. We got a really good basis on this with an assumable loan. So we'll talk a little bit about that. You cannot go wrong if you buy it right. So that's the first is you do the deal right when you buy it right. So we think we're getting a very good price for this. There is a value add opportunity. By continuing what seller has been doing, upgrading the units, other expense reduction, and managing better on the deal. Experienced sponsorship teams, as you saw, between TVG, Massive, Amber, Janae, we've got a lot of experience on the sponsorship team and minutes from a lot of employers. So this market is really growing, and I'll show that map in a few minutes. So just a summary of the deal again. We have purchase price of $16.9 million, total 204 units. So comes out at just under $83,000 a door. Total equity that we're projecting to raise is $6.6 million. The PPM subscription document that you see has some room for extra equity, but we're now settled down to $6.6 million final. We're projecting an 18% IRR over a 5-year hold. Over that 5-year, we expect on average 7 to 8% cash on cash. So later in the slide, I'll show First year is a little lower, but then from second year onward, we expect to be a nice cash flow on this. 2.11 multiple and minimum investment of 50,000. This property is in a C-class location and a C building with 1970s build. It's a C-class building from an age perspective. The area is, we call it C plus. It's a rapidly gentrifying industrial area, and we have a assumable loan at 3.78 fixed interest rate. So looking at the property, you can see a beautiful picture of the pool with the units around. A lot of space for this property that we have. It's in the northeast side of San Antonio, garden style, built in 1974. At the time we got into contract, it was 96.6% occupied. Seller have mostly maintained that occupancy since we got into contract in October, and we continue to do that. So here is the map. So over here is the San Antonio. On the top is this Austin, and this is the 35 along which this growth continued to happen. And of course, the traffic off of 35 and long-term projection by 2045, some estimate that 53% of the San Antonio Austin is expected to live within this I-35 corridor. And Austin is the single largest source for San Antonio in migration, right? So as Austin tech sector expands along 35 in this direction, helps San Antonio for this northeast direction. And our property is right off of 35 on this east side over here. So looking at this, so this one is tilted a little bit. So on the previous one, 35 goes on the on your screen from bottom left to top right, but this one is turned a little bit just to show all the businesses better. So I-35 on the east side is our property, and then HEB Distribution Center, Amazon Distribution Center, a few other businesses not far from our property. Pepsi, Frito-Lay distribution centers that are there, so a lot of employment. And in this picture, you can see the east side of 35 is more industrial. There is more residential on the left-hand side. So, you know, we have limited competition from other residential properties. So that's a good and a bad thing. Good in the sense that there's limited competition, bad in the sense that some people may not like that industrial feel. But once you're inside the complex, it really is such a large parcel that feels very residential. And once you're inside our apartment complex. So we have a value add opportunity on this property, this deal. Overall, we are continuing to renovate the 28 remaining units that are classic. Still classic, potential to convert a few of the building space that is not unit. So from the office, the clubhouse, convert into a new unit, implementing the water conservation program to reduce the water cost. And on the exterior side, there is some deferred maintenance as well as the curb appeal items. So roof, siding, patio, parking lot repairs, landscape and curb appeal, playground, doing those things, the fence repairs to kind of bring the property's appeal up, and then doing the exterior lighting with LED. So seller has done few, but there are a few that are still not done. So converting those to LED, new signage, potentially adding some storage units, parcel lockers for additional revenues for exterior to add value for the property. Here are some pictures of the units. One of the best thing about this property is that all the units have tile flooring. So when the tenant move out, that's a huge help from a cost perspective for the term when we don't have to go and replace the flooring, because flooring tends to be one of the most expensive repair when the tenant move out. So very nice unit. The upgrade units have tile surround around the tubs. black or stainless steel appliances. There's a backsplash, not shown in this picture, but there's a backsplash in the kitchen done by the seller that adds a little bit of attraction to the unit. Of course, from a value add perspective, continuing the technology package that seller has already contracted and implemented, the parking, charging the parking for overnight and parcel and storage lockers, continue those and add additional revenue. So our business plan, once we acquire and close on this property, is from day one, implement a professional property management company to enhance marketing, attractiveness for the property, efficiencies, collection, tenant appreciation events, those type of things to kind of build a community around all these things. And then start to implement the additional revenue or cost reduction initiatives as we take over. So increase the rents where possible, add storage lockers, parcel lockers, continue the tech package and the QR, parking for overnight stays. From a expense reduction perspective, water conservation and electricity contract negotiation and LED lights, and then the quicker maintenance term with on-site staff. So seller have had issues with the term, have taken a little longer. So we're hoping to get them turned quickly and lease them quickly. Enhancing the curb appeal to get the attract more tenants and keep the property full. Rehab and turn the remaining units, so only 28 left that are in classic condition, and then add additional rentable units, and then monitor the NOI, run the property for cash flow, and look for an appropriate time for exit. We have a flexibility since we have 7 years on the loan, so we don't have a rush to sell at any point or loan coming due in any time soon. So from an underwriting perspective, here are the projected returns. So if for somebody doing a sample 100,000 return, we have a 7% preferred return. What that means is from the operational cash flow, no money goes to the GPs or us as sponsors before the 7% preferred is met. Of course, the asset management fees are separate, calculated separately, and those continue at a 2%, which I have a list of all the fees later in the deck. We have a 70-30 split, but that 30% doesn't kick in until the 7% pref is met. Our purchase cap is 6.5%. On an exit, we have a 6% exit cap assumption. As the interest rates drop over the next few years, we do expect the cap rate to drop. Both the CoStar projections, when we look at cap rate in San Antonio, are expected to drop, and that's what we're assuming, a conservative 6% from that. 6.6 million total raise, 5-year hold period. So on a sample $100,000 investment, there is, year one, the first half of the first year, we stabilize the property, implement some of the things, and start implementing the program that we discussed, value add program that we discussed earlier. So, but we still expect a little over 5% from operations cash flow to be able to distribute it. Typically, we start in the second half of the first year after stabilizing. And then from second year onward, we expect the cash flows, to grow as we increase the income. So 7, 8, a little over 8% by year 5. And then at the year 5, we exit. If we exit in year 5, the proceeds from the sale and the total cumulative return at $210,000 for $100,000 investment. Here's a list of all the fees that we are building into the model. So these returns of IRR at 18% and equity multiple that we are projecting are after these fees. So we talked about the 70-30 split that we have, but again, that 30% does not kick in until the 7% pref is met. At sale, 30% kicks in only after 100% of the capital is returned to the investors first. So our interests are aligned with our investors, and of course, so there's an asset management fees of 2%. That's just an ongoing basis to cover the expenses for management entity, the annual tax return, and other things that we do from an asset management perspective. This 2% is calculated on the gross collection, same fee that is collected on the property management fees. Again, property management is not listed on this page because that is not a fee that goes to us as sponsors. That is a third-party management, United Apartment Group, UAG, and we have an agreement of 3% with them. We do have an acquisition fee of 2% built in here, one time upfront upon successful closure of this deal. So this covers us running around, finding the deal, underwriting, funding the upfront escrow, the deposit, the loan fees, and everything that we've been paying so far. At the time of sale, there is a 1.5% disposition fee that we have built in just to incentivize highest price exit for everybody's benefit. We do have a project management fee of 5% built into our CapEx budget. If property management end up handling the CapEx for us, they typically charge 5%. If needed, we may need a project manager on site. So we do have 5% there that we may charge if and as needed. So the sources and uses of funds, our purchase price is $16.9 million. And after the loan assumption and the supplemental, our down payment that we need to bring to the closing is 4.175. And we're budgeting just under 1.2 million of capital budget, closing costs, acquisition fee of 591,000, and then some reserves from operations perspective, 668 for a total of 600,000 for the rate. The original loan that we are assuming is 10.16 million. And in addition to that, we do have an approval for a supplemental at 2.574. So 10.16 and 2.574 combined is our debt, which leaves us the down payment of 4.175. On the financing side, we are assuming the $10.16 million loan, which is at 3.78% interest, and we have approximately 8 years remaining on the loan. So we have until 2031, end of 2031, for the loan to come due. And our supplemental have exact same terms as the underlying loan we are assuming, except the interest rate. So supplemental will have 8 years remaining with the interest rate of 8.54. This was the original price that was quoted, and the final price interest rate that came from Fannie Mae was 8.52, I believe. Amortization of supplemental will also be on a 30-year basis. Here is the underwriting detail, and if Amber is still up for it, I'll let you talk through the underwriting, Amber.
You know, I'm always up for a little underwriting talk. They only give me a couple of minutes, so I'm going to try to keep it as exciting as a couple of minutes on this page can be. But I love this because it's basically a numerical snapshot of how we're going to achieve these returns that Sanjay talked about at the beginning of this presentation. Just to kind of familiarize everybody with this, if you haven't seen one before, across the left-hand rows and columns, I always get those confused, but the thing going up and down on the left-hand side, yes, you have all sorts of categories. You have rent, escalator, income, expenses, and NOI down at the bottom. Across the top of the page, you have the T12 numbers. Those are the numbers from the previous 12 months. Then you have our projected numbers for year 1 on out through year 5. So that's a crash course on how to read one of these. Couple things I want to point out about why we love this deal. The average rents for the last 12 months were $11.23 per unit. And we've projected year one to go to 1190. And I was looking at some of the more recent numbers on this, and we're inching our way up to that number before we've even taken ownership. So I believe we're about halfway to that already, and we haven't even closed yet. So I don't feel like that's a big jump. And then we have a conservative 5% increase year two in the rent. And then 3% years 3, 4, and 5. So we feel like that's pretty conservative with the rents that we're starting with. Let's see what else we got going on here. We're going to be taking advantage of some utility efficiencies. So one of the things that Sanjay had touched on very briefly was a reduction in the utilities. So we always contact utility, I want to say conservation. I'm not sure if that's the right word, but utility specialists who can look at our utilities and tell us, like, this is where you can save. And we realized that with the electric, we were paying a 6.25%, or the previous owner was paying 6.25% tax that we will not have to pay. So right off the bat, we're decreasing the electric utilities by 6.25%. We believe with the other energy efficient things that we're going to do to replace that, it's going to be about a 10% decrease in electricity. Same thing with the water savings. We've talked to several different water savings companies and feel very comfortable with the modest reduction in expenses that we have there. So that's basically what we're looking to do is squeeze down the expenses and maximize the income. And I feel like we've been very conservative with both of these, on both sides of that. One example of that is our real estate taxes. If you look at the year one pro forma on that, it's 415,740, just a little bit over there to your right. There you go. And those just came out in September after we locked this underwriting in. And they came in at a pretty big reduction on that. So we're going to have another reduction built in there. So we feel like the only kind of surprises we like are the good ones. So we feel like we have been very conservative on all that. I want to make sure to hit all of the points here. Oh, if there's somebody that's really digging through this, you might see the insurance on the T12 to the year one went from 161 to 100,000. That 161 on the insurance for the T12 was for the previous year, and the seller just re-upped the insurance also in September and was able to re-up her insurance for only $85,000 for the year. So because this is an assumption and we're keeping the same insurance company, we're able to take advantage of that lower rate. So we don't want to get caught in a bad situation. So we did bump it back up again for year 2, 3, 4, and 5, just in case they come to their senses or figure out they made a mistake or something. But again, the theme here is conservative underwriting, and if there's surprises, we want them to be in our favor.
And Sanjay, there are quite a few questions in the chat that are related to this, so it might be appropriate to answer them now.
Yeah, thank you, Trevor. So yeah, let me address a couple of those questions. So one of the question is, we're assuming a 6% increase here, but no increase in the vacancy. So this 174,000 is approximately based on a 6% vacancy here. But the 6% increase leading to 1190 average monthly rent, what Amber said is Stella is already getting this average rent very close to it. So we're really normalizing our year one to where the seller is today. So we don't really have a big increase, true 6% increase. Yeah, it's a 6% increase over the last 12-month financials. So that's where we didn't need to increase the vacancy drastically. And seller had some vacancy earlier in the year. Recently, they've had it very, 96.6% occupied, right? So very low vacancy. So that's where we didn't need to increase that. And year two, 5%, typically we would say that's a steep increase, but our market rent going into our property are around this 1250 number. So what we're saying really is that year one, we're going to start where the seller is, we'll increase the rents a little bit, and by the time we get to year two, we are close to this 1250 and we continue to increase slightly in year two. We don't have true that much increase. And of course, in these 2 years, market rents will go up. So we will still have a catch up to do from a cushion perspective on the market rents. So that's where we think we feel comfortable on this vacancy and these numbers. There's another question on utility tax that the previous owner. So what Amber mentioned, we use a energy broker. They review the contract and they know the marketplace. Of course, this area of San Antonio is not deregulated, so we only have one option to go with for electricity. But in Texas, residential electric consumers are not required to pay the 6.25% sales tax. So that is not applicable. In fact, seller can potentially go back and claim that for the last 2-3 years that they have paid. So that's the main reduction, in addition to some LED usage and reducing that. So, and that's the reduction on the electric. Again, there's a question on the vacancy that if we upgrade the units, won't we see a higher vacancy? So remember, we only have 28 units to upgrade. Seller have already gone through and done the upgrades for the units. And given the Class C area, Class C level property, we don't have major upgrades where we are installing. We're not installing, granite countertops and undermount sink and those type of things. These upgrades really are a nice paint. Flooring is already nice. Changing some fixtures, backsplash, appliances, and that's really it. So really, it's a very close to a normal turn with fixtures and few nice pieces thrown in there that we will continue on this. And really, for given that market, that's really what it can afford from a rent perspective. There's another question. So that's why we don't expect the vacancy as we continue on those 28 units. We don't expect the vacancy to spike up. So where do you see market rents in this area going? So I have a rent comp slide after this, so let me jump to that and I can talk about that. How did you get to the market concession 10K per month? Is that a lot when considering a drop in vacancy? Yeah, so the concessions here, seller did a lot of evictions clean up earlier in the year, and then they have stabilized the property. So we're kind of taking the most recent 2-3 months and analyzing that, and then kind of taking that. We have a little higher because when you take over the property, new owner, always there's a higher loss to lease or bad debt. But as we stabilize, we should be able to perform and carry on to that. So yeah, I think it's a loss to lease, delinquency, concessions, all of those combine into this one line item. Good questions. Please feel free to continue typing the questions. Here are the rent comps. So from a rent comp perspective, Nexus Urban Living, this property here, which is this one right here, Trevor, our famous Trevor actually has the ownership stake, sponsorship stake in that property. They are managing it, they are running it, and so we know firsthand the rents that are listed here for Nexus are achievable and are being achieved at that property. So when we compare to our property to the Nexus, which is the best comp, so we definitely have a room today. And then as we go, next year, the year after that, rent will continue to grow. And we're really kind of getting to this $1.20 for 2-bedroom, $1.50 for the 1-bedrooms. And as you see here, on average, $1.37 and $1.44 by year 2 is what we're getting to. So we have those comps. Nexus is the best comp. As you can see, there's not a lot of apartment complexes on the east side of 35. Most of the other properties are on the west side, where there is a lot of competition. On our side, there's less competition. So if you do the marketing right, our curb appeal right, which is part of our plan, we should be able to attract good tenants, well-paying tenants, and able to push these rents. From an exit strategy perspective, on the table on the right-hand side, at the end of year 5, our projected NOI is 1.599. And just as a reference, this is the NOI from year 5 for our projections pro forma here. So we take this 6% exit cap rate, projected sale price, which puts this property at $130 a door, building in some sales costs, loan balance, total, bringing a total sale proceeds to this, returning the original capital, and then the 1.5% exit fee that we talked about earlier, and then the remaining proceeds available for distribution, and those are the ones that get split 70-30. So we have a 7-year term, a 7.5-year term remaining on our loan. So we have flexibility. If the market varies a little bit, we could exit sooner or later. We have that flexibility. Really, as soon as we reach this NOI, we could trigger the sale or look at selling it, or if you're cash flowing nicely, we can hold it. Of course, that's a decision, collective decision for all of us to make. Bottom right table, we have a little sensitivity for the cap rate. We are assuming a 6% cap rate. If we, quarter point lower, gets us a little more funds, a little over $1 million. If we drop as high as 6.5% cap rate, we lose a couple $1 million on our total profits. But that's still, from a sale perspective, we still have margin on our profits. So of course, instead of 6 million, there will be 4 million available for distribution if our cap rate gets pushed to 6.5%. But we really don't think cap rate will go above 6% that far out when the interest rates are lower. We do have the cost seg. Okay, thanks, Maria, for updating. These are the correct numbers. This closing has gotten pushed into 2024 now. Originally, we were trying to close in December 23. So these are the updated estimates from our cost seg partner, Madison Spec. They are the vendor who do the cost seg for us. So they are projecting in year 2024 for approximately 38.5%. So for somebody investing 100,000, they can expect to receive approximately 38,000 in paper loss from this. The total depreciation is 72% over the life of the deal. So after the first year, following 4 years, there's an additional 33.5% depreciation expected over those 4 years. So this is combined. So if you split it over 4 years, another 9,000 of depreciation every year for those 4 years. That continues. From a timeline perspective, I think we got our timing here wrong. We had the original LOI and the PSA in September. We completed our due diligence in early October. We've been working with Wells Fargo, who is the servicer for the agency loan since then. They have everything now, and they're ready to submit to Fannie Mae for final approval. But we were in a 506B phase for this until December 25th. starting December 6th. It's the 506C, so it's open only to accredited investors. And now our expected closing date is January 25th, which is the date that has been committed by the bank, which is Wells Fargo. So there it is. So that is our current expected closing date. It may move a couple days earlier or later, depending on when our loan assumption completes. But we are really trying to close before the end of the January for this. That's all the prepared material I have. We'll open up for questions, feedback, and we have the other people from the GP team here. So anybody have questions for the other team members, happy to answer this.
You can feel free to unmute yourself. You should be able to, or put your question in the chat. You had some great questions earlier. So I always say these presentations are only as good as the questions. You get some good questions, it's a really good experience to learn.
Yeah, absolutely. So more the merrier from a question perspective. While we don't have any questions, we're waiting for questions. Please speak more about the plan for storage facility monetization on site. Okay, so that's a very good question. As you see on our pro forma, we actually do not have any additional income from storage itself built into anywhere here. So with that said, our pro forma doesn't really take into account any additional income, but the property, it's hard to see on this, and I don't have a readily available map, but there is a lot of space available all around the property. There's a big playground, and there is like 3/4 of that playground, there is empty space. So we could put some storage facility like this and charge $75, $100 a pop, and these things are fairly easy to put. Of course, we will have to go through the permit and approval from the city or any issues. We do still have to resolve those. And then we do that. And permit and approval, that's the reason we did not include any income from this in our pro forma, but definitely something we want to explore. And, we get 25, 30 of these things scattered around the property. And that's an additional $3,000-$4,000 a month in income. And that's a nice jump in our NOI, free $40,000-$50,000 a year for everybody.
You let me, Sanjay?
I'm sorry, say that again?
No, just adding about the all of the things here. What we want to do is bring more value to the tenants, right? So there's a lot of people moving into that area, and we want to bring up the perceived value of the tenants and the future tenants in order to get the best community we can get there, right? So all of these mini storage tenants for the tenants, all of the things for the Amazon packages, for the playground, all of those things, apart from being some more cash for us and for the deal, is also about giving value to the tenants and building a stronger community than what we see today, right? That's one of the important points that we saw when we watch this opportunity. Apart from buying it at a really great price, the thing is we can really change the community into the best community around there. As Sanjay told us, on the east side, there's not much competition, but for sure in the future, with all the people moving into that area, there will be some new buildings. So we want to bring and give everything that we can do to our tenants and having a better community.
Yeah, thank you, Nacho. Another question in the chat, do you have any rent comp on your side of the city? So we actually looked hard, and there's really no apartments on this side of 35. There is some housing, some residential houses on this side. There's some there, but really no apartment complexes. But really, the Nexus and Sola, these two really compare very well to us. And when you're looking at somebody who's looking for housing, they are working on any of those warehouses or any of these businesses, they are okay to live on either side of 35 and look for something affordable, something nice. We get that feedback from UAG that those are the best comps for our property to look at, biggest competition. So from that perspective, we feel those are the good comps. Question, do you have any scenario analysis? If not, is your underwriting available for us to run this? So from scenario perspective, the biggest sensitivity of the model and returns is on the exit cap rate. So we do have this scenarios for the exit cap rates. 6 there, slightly below, slightly higher cap rate. How does that impact on the cash sale price for the property? From a rent perspective, I think we haven't run any rent like increase analysis there, but we do look at our break-even occupancy. So I don't remember exactly, but we can let you know our break-even occupancy. So as long as we are at that break-even occupancy, which I believe for this property is in low 70s or high 60s, meaning as long as we are 68, 70% occupied, we have enough cash to pay our expenses, right? We are not negative cash flow. So, but yeah, happy to discuss any of the scenarios that you like, or talk through them. There's a question here which I don't understand. Why is this lady selling? So please clarify that, what that question mean in the chat. What's the average household income in this area? Ooh, we did have a slide on median income. I did not see that. I'll park that question. Amber, Maria, could you look at that, see if we had that on one of the other slides, or where was that on the market review? On the rent appreciation, occupancy, break-even occupancy for year 1 and 3, please. So break-even is around, thank you, Vinny, 71 to 75% occupancy from starting year one at a higher, going down to the 2nd and 3rd year. Very good question. I like these questions.
And I also think that they're asking why is she selling. So she bought this property at a very good basis. It was a very rundown property. It had lots of issues. She took it over as a sole GP and property manager the first time of anything of this size. Did a huge upgrade, survived COVID, did all kinds of things, even selling it at a reduced price to us. She is coming out very well, and she worked very hard to get there, but she is tired. She's done. She's been really performing well. Like, she's not lost interest in the property, which happens sometimes after selling. This is her baby, and she wants to deliver it to us as healthy as can be, but she wants to get paid, move on, do some travel, do some other things in her life. She's at that stage.
Yeah, I get it now. I'm sorry I missed that question.
That's
Thanks,
okay,
Trevor.
Yeah,
Thanks, Trevor.
Yeah.
And
Trevor, she's been awesome. I mean, I knew her before we bought the property as well, in the area, and her husband well, and she's put in a tremendous amount of work. If you can imagine, self-managing, 204. I think when she bought it, it was in the low 70s occupancy, and she's done a great job putting it together.
Yeah, and she's really ready to just take a break and self-built person, a lot of respect for the seller, and she's ready to take that break. And we've been, one other thing I missed earlier is originally we made an offer on this property back in March 2023. Seller wanted a lot higher price than what we offered. And our original offer was 16.75 million. Since March to our timeline here, September, seller did improve the performance of the property and increase the rents. So March to September, when we look at those, look a lot better than these T12. So when we look at T3 financials, those look a lot better. So a lot of work done, and realizing the market, you have the market where it is, and that's where we think we got a really good basis our purchase. Because even though we're getting a lower interest rate, we did not want to bump up the price, because at the exit, whoever gets in, I don't think we will get to those 3% interest rate. Maybe 5 years, 7 year we could, but 4.5%, 5% interest is not out of the question. So if we do get in those 4.5%, 5% interest rates, then the cap rates for this property definitely would be below 6 from a projected perspective. So the average rent for Class C in this area, so these were our rent comps that we discussed. Michael, Sola and Nexus are the two best comps, but we have these others that we also listed. Some of these properties are a little far, but from a total market perspective, we did want to look at those. So some of those far away ones are a little bit lower than ours, but we don't have very many apartments in this area, which helps us from our pricing. From an average cap rate perspective, Amber, you had a really good chart for the projection.
I was getting some feedback there. What was that, Sanjay?
Sorry, you had a chart on one of our calls for the cap rate projections. If you have handy, pull it up. Otherwise, Juan, we will share the average cap rate, historic as well as the projections for this.
Let me see if I can find that.
Okay, while you look at that, Amber, another question. It is the source of this deal. So it came to us through a broker. It's a very smaller brokerage. I think the broker has some sort of a close relationship with the seller, like a long-term. I think that broker may have helped find this property for the seller a few years ago. So it came through that broker, who I originally talked to back in March 23. And actually, Amber, Janae, and Trevor were the ones who went to visit the property back in March and met the seller. So, okay, so Trevor, thank you. The broker, same broker as the GP for the Nexus. Yeah.
He just noticed that I was registered as someone who
okay.
bought one and sent it to me. But he's the same one who found the deal for her, yes, originally.
Okay. Vinny, you can share the screen with the cap rate forecast that you have. Yes, please share that.
Can you guys see my screen?
Yeah, there it is. Yes.
So this is the forecast we're using, and each line represents a different submarket. So northwest, and it's just San Antonio in general. So we can see here on 27, it's between 5.6 and 5.8. That's around it. So was that the information you wanted to see?
Yes, thank you. This was the chart I was thinking. So really, this aligns. There's a slight difference based on the type of properties, but all the lines kind of move in very much parallel. So by the time we get to 27, 28, we expect the cap rates to drop below 6. So the line 6 line is here, but we're keeping a conservative 6 cap rate assumption for ours. And of course, we are buying at 6.5, which is right where the cap rates are currently.
The source for cap rate for forecast is CoStar.
CoStar, yes, CoStar. Okay, good questions. Let me continue with these questions. I will, okay, there it is. It was mentioned that the majority of the renovations will be exterior. Would that be pavement and fence, or is it more targeting the exterior of the buildings? So, so we have a considerable amount of budget for roof, and then there is some parking lot, fence budgets. From a CapEx side, we did put some budget for the storage lockers, as well as the some of the storage units. But again, that's a little bit not 100% clear. So we did put some budget there, but for interior rehab, we really only have I think a couple $100,000 for interior rehab, but most of it is for exterior and roof and siding, and the curb appeal takes a big chunk, and then the parking lot fence and those things are the rest of it. Okay, so renovations. How much money are the GPs putting into the deal? So, so between TVG, Massive Capital, we typically like to put considerable amount. Some of our deals do get oversubscribed, so but we still leave. At this point, Massive Capital has committed 100,000, and TVG has committed 100,000 at a minimum to invest, and then the other co-GPs may invest also. So we have a minimum that much that we will invest into the deal. The minimum investment is 50,000. Somebody answered the questions there. What is the median household income for this area? We will pull that data and get back to you. We don't have a slide here for median household income for the area.
Sanjay,
Yeah.
I've got that slide.
Oh, you do? Okay. Are you able to share? Let me stop sharing.
Yep.
There it is. Go ahead, Amber.
Now I gotta find it. There it is. Okay. So we're at 32,889.
Yeah. So within the 1 mile radius, it's a 32, 33. And as you go out the 5 mile, and it goes up slightly, I think.
Yeah.
Yeah. So of course, as you go 5 mile is like 90,000, right?
It's 55.
Oh, 55. Okay.
Mm-hmm.
So 1 mile, 32, 3 mile, 51, 5 mile, 55,000.
I just want to add here, Sanjay, that on the 1 mile, we can see that we have less than 3,000 houses. So that's why it's so small, that amount. I think the 3 mile radius is the one that it's accurate, because with the 1 mile, it's almost everything industrial, at least on the last census.
Yes, and that's what I was going to point out. In 1 mile radius, you see majority of that circle is on the east side of 35, where there's not a lot of housing.
Right.
And just stay there, Amber, for a second.
Mm-hmm.
And as you see, the household within 1 mile is less than 3,000. and the 3 mile household all of a sudden is 36,000.
Right.
So a lot of households in the 3 mile radius as opposed to that 1 mile. So, you know, with the industrial solid blue collar workforce housing there, basically, demand is always there. Those warehouses are long-term planned and don't go anywhere and don't change or get moved. And if anything, more and more warehouses get built in the areas that are there. So we really think from a income perspective, we are okay.
Yeah, and
So
just
the
to
question
add,
is, do you have housing program tenants? Go ahead, Nacho.
sorry, Sandy, just to add something, as we saw on the slides, we are not kicking up the rent. So right now we have over 97% without doing any marketing. So the problem right there is not the rent rate and pushing the rent rate. There's a lot of things that we can do. So on the rent rate, I think we're really conservative on that side.
Yep. Okay. There's a question about, do you have housing program tenants at this location? So seller does not have any Section 8 tenants, but seller did have a few tenants on a program that was some Afghanistan refugees and some of those that were allowed by the United States, and first 6 months, 8 months of their rents were paid by that program, federal program. Most of the tenants that are on the leases on that program, most of those programs have expired, and those tenants pay tenants like clockwork because they work, they are here to build their life, work hard, again, and opportunities are there. So it's a little bit of a tricky thing that we don't have any Section 8 housing tenants, but we do have some of those on those federal programs. They were, and there were few tenants that may still be on that program that we continue to maintain and continue just continue to keep the paperwork clean for those tenants.
And San Antonio is an
questions. I
interesting
like
market
this.
that they are still actually doing some rent relief, even left over from COVID. So again, we mentioned I'm in the Nexus property, and we've just had 4 tenants that have had 3 months of back rent paid by the city on the promise that this will just help them get caught up some sort of. So San Antonio is an interesting market that it is actually pro tenant but pro landlord. They'll pay you if you have them stay, as long as the tenant agrees to start continuing paying. So that's the nice thing about that area, San Antonio. It is a friendly jurisdiction.
You're right. I used to own a portfolio of 16 single-family homes in this exact area where this property is, right here. And on my houses, I actually did have a few SAHA, San Antonio Housing Authority tenants, and SAHA is one of the highest payments. I am based here physically in Dallas-Fort Worth area, and on my portfolio, my other properties, I've dealt with Dallas, Mesquite, and other housing authorities. And San Antonio is by far the most generous on their rents, and they pay like clockwork. Of course, they have their inspections and those requirements. You have to work with that, and they tend to be pretty strict on that. But even though we don't have any housing tenants, it does help when the housing pays that high and that well. It helps the market overall from a rent comp perspective.
No, but I was actually referring, we went to court for eviction, and the city actually paid their back rent And then the tenants have kept up paying since the city got them caught up. Yeah, which is unheard of in most
Oh, they
jurisdictions.
did.
Literally 3 tenants, almost 3 months in.
Nice.
And they've been 3 months paying on time. So
Yeah. Okay, I stand corrected. We
Yeah.
do have some Catholic Charities residents as well as Saha tenants. Thank you, Amber, for correcting me. I know we talked about those, the refugee tenant and those leases, but I didn't, I missed that we had the Saha. So we do have some housing tenants currently. Is crime an issue in this area? So, as we were talking earlier, not a lot of residential activity in this area. So for our property, if you look up online, we don't tend to see a lot of criminal activities or incidents. There is a fence for the property, so we have a clean sort of a barrier for our property, but for the property, there hasn't been any issue for the last few years. And as far as we know, crime is not an issue for this. It is a blue collar area, a lot of workforce housing. So, if you drive by, when you take the exit off of 35 and go here, it looks a little rough around the edges, all these areas. But we haven't seen any crime type of issues at the property or around the property. Good questions, very good questions. Now, who's ready to invest? That's my question to everybody. And what will it take to get you to invest? Anything, you can ask anything, and let's go, let's close this and get it rolling. This is the beginning of 2024. We really had this deal lined up for 2023 end, but as we do our investor projections from our pro forma perspective, it's a great deal to start 2024 and build up the cash flow for the future years, lock this down and move on and get into this. So who is ready to invest here? All right, Vinny is ready. Thank you, Vinny. Amber. Awesome. Well, we are 7 minutes over. We will hang around. Anybody have any questions, please feel free to ask. And if you need to drop off, feel free to drop off. We will have a recording. This was recorded, so we will have a recording that we will get out. Thank you, Maria, for helping with all that. Of course, reach out to any of us for any questions, comments, feedback. Always welcome any feedback also.
Yeah, great job, guys. This deal, we're excited to be a part of it. Excited for 2024.
Thank you. One more question, just to make me happy. Come on. Somebody can come up with one more question.
See.
When do you start? When do you
Distribution.
anticipate the distribution start?
There it is.
Awesome. Thank you. So as I was talking on this one here, in the year one, we expect 5.38, a little over 5%. So typically we keep the first 2 quarters to stabilize the property. So if we close at the end of January, until end of July would be our stabilization period. August, September, October would be our 3rd quarter of operation. And we would expect to distribute like a 2% or so by July, August, September, October. So end of October, November of 2024 is what you can expect the first distribution. And then after that, November 24, expect every quarter a distribution that should annualize to approximately these numbers. Additionally, one of the things, if the interest rates really drop a lot, and our supplemental is at 8.25, we do have an option to explore refinancing options in the second or the third year. Really depends a lot on the market. So we don't really have anything in the underwriting for that, but just gives us one of those additional flexibility. Sorry, I'm trying to find that slide where we have the debt and sources and uses of this. There.
Oh, you just went by it.
But again, if the interest rate do drop drastically, we can refi, get out of the supplemental, get some cash out, and try to do that. But that's not a firm plan at this point. Thank you, Elise. Good question. Any other questions? Yeah, that's a good point. Depreciation, as you know, the bonus depreciation that we talked about here is at 60% this year. It's been going down. So next year, 2025, it goes to 40%. And what that means is only the real estate portion can be used for accelerated depreciation. That we mean here, and you can only accelerate 40% in 2025. 2024 is 60%, 2023 was 80%. So it is a step down every year as we go. So goes back to, hit the year running, get into a good cash flow deal, and let's get this deal going. Yeah, and that's the other good point. The 60% after cost seg gets locked in, and then the next 4 years kind of gets rolled out an additional depreciation that's there. So you kind of lock that in as you invest in this deal in 2024. And again, these are all estimates. Please look at your individual situation. Are you able to use that depreciation to offset your taxes or not? Talk to a CPA. We will issue K1s with those information. How it works on your side, you have to look at your individual situation.
Well, thank you all so much for coming. Sanjay, I'm cutting you off. I'm so sorry. I think we got some really good questions tonight. If you are ready to invest and take that next step, please reach out to one of us on the call. Reach out to the person who invited you to this call. That'll be the easiest. If you have any questions, all of us have put our information in the chat. We'd love to talk to you more. And we thank you for spending this time with us. We know that your time is valuable, and we are so appreciative of this opportunity to spend with you. So thank you so much. And we hope that you all have a great evening. And here's to investing in 2024. Have a great evening, everyone.
Thanks. Good night, everybody.
Good night.
Thank you, everybody. Good night.
Good night.